Coming up on today's episode.
This gentleman said he want to buy a property and his plan is to sell off, let's say, in 1 to 2 years' time. And he have no experience of property in Australia. And I told him, why are you considering property then? Why do you want property as an investment class? Because if you just want to hold for 1 or 2 years, you need to consider the holding cost. You need to consider the costs which are involved when you buy the property. You need to understand there are costs when you exit, when you offload the property. And let's not forget capital gains. Property is a good investment, but it's not going to make you rich overnight.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together. Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, today's episode is for investors or anyone who's thinking about getting into the property market and wants to cut through the noise. You've probably heard a million people tell you about the latest hotspot or postcode, but what if I told you that property really isn't about property at all? That's where we're unpacking today with my guest, Ravi Gupta. Ravi is an investor's buyer's agent with his own $5 million portfolio. He's been a property manager, managed over 200 properties, worked as a corporate data analyst, and has renovated homes with his own 2 hands. And now he helps clients all across Australia buy smarter with an investor-first mindset. So, in this episode, you'll learn why finance and leverage are the real backbone of investing, how different strategies work depending on your age and risk profile, and the biggest mistakes that first-time investors make, and we'll even tackle some real Reddit debates to see how Ravi would handle them. So, Ravi, welcome to the show.
Thanks, Joe. Glad to be here.
I'm so glad to have you here because when we caught up for our pre-podcast interview, what really stood out to me was just the way you've got such a broad background, right? Like I feel like anyone who's been a data analyst in corporate has a very different way of analysing the property market, like a better way of doing it because let's be honest, like when you're property investing, it's not so much about the property, like you said, it's about the data and the finances and making sure that the strategy lines up. So yeah, I'm very excited for this conversation.
Yes, so do I, Joe. And yes, I agree. It's not about property at all, especially if you look at the investment side of the things. It's all about finance, leverage, how you structure those purchases as well. So yeah, it's all about that. And
Exactly.
property is just an asset class.
It's so true. And that's why, I thought this will be a really important episode for a lot of people to hear because we're in that time of year now where it's spring. So if you're tuning in, we're recording this episode on September 22nd and we are in the middle of that place where everyone wants to buy. So we've got a lot of people on the market at the moment. So this is why the episode and you coming on the show is so timely. So we're going to try and get this episode out pretty quickly so you guys can structure what your plan is going into the end of the year. So I think with all good places to start, Ravi, the best one is always your background, because you've done a lot in this space. Tell us about your very first exposure to property and what got you interested.
Yeah, so Joe, I still consider myself as a new migrant in this country. I moved in 2018 and I'm from India and back home, I've got a couple of investment properties as well. I offloaded one of the properties last year, but I still have one there left in India. So, the first job in this country was a real estate manager and I was working with a franchisee who used to manage 800 properties. And that was 4 of us who were managing those 800 properties. So, we had a big portfolio of properties. And if you do the math, so I was managing around 200 of them. So,
I was about to say, like, that's 200 properties. That's a lot.
Yeah, it is a lot. People, sometimes they do not understand, it's not only about properties, I was managing 200 investors, right? And If you look at the number of tenants, if you have like 3 tenants in a property on an average, I was managing 600 tenants.
Oh my
So
God,
you
just
can,
those numbers are so
yeah,
overwhelming.
yeah. So you can see that, you can see the volume, and that's why I always say real estate. It's all about people, you know,
Mhm.
and having those relationship. Properties and numbers, they come second.
Yeah, spot on. And I think your exposure into like the world of property management, like it's so interesting that you started there because that would have given you a lot of good foundations for, managing the assets, number one, but two, seeing what types of like assets and these investors, the decisions they made, the tenants, and having to manage that whole flow because it's quite extensive. And a lot of people don't really focus on that secondary part. They always focus on the getting the asset first, right? Which
Yeah,
makes sense.
yeah,
But
yeah.
you would have learnt a lot and you would be able to guide your clients very differently because you've had that exposure.
Correct, 100%, Joe, because obviously I've got hands-on experience managing the property. I used to see problems day in, day out, whether it's plumbing or, anything related to tenants issues, happening in the property. So I used to experience that day in, day out. And how you also manage the investors' expectation across that, because at the end of the day, investors, they are not there for charity, to be honest. If somebody is investing their money, they want the ROI as well.
That's right.
So I need to take care of that as well, because if somebody is not making money, they will probably end up selling the property.
Yeah, correct.
So I need to kind of balance everything, because there are people involved, there are expectation involved, and there are numbers involved as well. So you need to bring into all the aspect, whether it's your people skill, your finance skills, and or your analysis skills on the table.
100%. And it kind of goes into like my next question was, so, you started in the property management space. You had a couple of properties at this stage, in India still, you've immigrated into your first role. How did you make the switch into the data analyst position and getting into corporate?
Yeah, obviously, I was doing a lot of number crunching back in India as well. I come from an IT background. So I started as a real estate manager here because I was very passionate about properties. And, I think behind the scene, I wanted to start something of my own, to be honest. But, so I thought, I'm going to a new country. It's a new world. So let me try something different. I spoke to a couple of my friends who are based in Australia, and they said, why don't you explore the real estate industry? It's a very good opportunity in Australia. You probably can start something of your own, because I come from a business family and I always wanted to start some of my own business. So I thought, it's a good opportunity. I'm starting a new life migrating to Australia. So I should look from that perspective, right? But very soon, I was enjoying property management a lot. It was fantastic, and as I said, it gives me perspective. It gives me an opportunity to learn the people skill, because in corporate, you normally work in your silos, right? You are assigned a task, you deliver the task 9 to 5, you enjoy your weekend, done.
That's true.
You hardly see a kind of team personality over there. Obviously, you're part of team, but you're pretty much working on your own. And we have seen that during COVID days, right? So, yeah. So I think working in real estate, it gives me perspective, but I wanted to start something of my own. So that was always in back of my mind. So I thought, I got the taste of real estate working as a property manager. I understand how the real estate office works, background, day in, day out activities. So I thought, let me step back. Let me, go back to the corporate. And, because I was new in the country, so I did not have much money. So I thought, I should, start investing as well, because managing the properties give me an idea of, investing in properties as well. I've done that in India, but obviously the industry over here is it's a completely different way of doing things here. So I thought, let me go back to corporate, make some money, invest in properties, and then probably I should, do something of my own.
I love that, because it's kind of like you've educated yourself through your own education as well, right? So let me go and do the roles and learn the foundations of how property works in Australia first. Then if I get good at it, I'll make the next steps in the decision. And I think often what a lot of buyers advocates, either do or don't do, not all of them do, but it's important that you have your own portfolio or your own investments because you've been in their position. You've had to assess the market from different angles. So, what would you say, being a data analyst, that's a pretty data heavy role, obviously, and there's a lot of, number crunching. How do you kind of apply what you learned there into transitioning that into property? What is the link?
Yeah, I was very lucky working as a data analyst, Joe. So, number crunching was my thing. And, you can drill down to different levels when you are analyzing the numbers, right? And you can tell a story using that. And you can look the things from different angles, to be honest. And I think that's what I've used in real estate, analyzing the data, looking into different metrics, trying to analyze, how it is going to benefit me short term, long term, how whether the portfolio looks balanced or not. So that's what gives me a kind of a power to do with properties.
That's awesome. And I think that makes a big difference, especially like you said, once you've got the portfolio, it's the stability of it as well. Is it growing? Is it in
Correct.
the right place?
Yeah. And I think using all that information, I started my property journey from 2020, just the beginning of COVID. I got my own PPOR. I think the timing was perfect. Obviously at that time, beginning of COVID, the market sentiments were really down. And, I got a really good deal for my own property. I'm based in Sydney in the Upper North Shore. So that's where I bought my residence 5 years ago. And within 6 months or 8 months, I had a massive equity because everybody knows what happened during COVID and after COVID as well. And so that was my first property. And in the last 5 years, I was able to, source 4 other properties apart from my PPR. So, and I'm currently sitting on a portfolio which is worth around 5 million. So five properties, 5 year, 5 million.
Congratulations. That is a huge accomplishment. I think I always get excited by this, with immigration, right? Because you come from a different place where you don't know the lay of the land, the structures, the financing. Yeah. It's there's so much to learn, even for an everyday Australian. We're born in this country. We don't know a lot, off the top of our head about how to invest. We have no idea. And I'm sure you probably see that.
Yeah.
And I love that story of you've done it and you actually can make it a reality for so many people by just giving them the right structures, which is what we're going to unpack next, because it's so inspiring to me. I just wanted to, give you that congratulations because you've definitely earned it.
Yeah, thanks, Joe. Thanks for that. And I think my experience working in real estate also helped me a lot because I was very confident when I was sourcing properties.
Well, yeah, of course. And you've been working in the field for full time at that rate, managing properties, but now you've got all the tools at your disposal as well.
Correct.
When you're in those roles, and you're I could play with this and this could help this. And it kind of starts setting you up, which leads me to that, next question, because at what point did you realize that, you'd built your own portfolio at this point? When did you want to go into buyers advocacy full time? What made you make that decision?
Yeah, obviously, I think, Joe, I told you, I wanted to start something of my own. I had a very clear thought in my mind because, I think I was not meant to do 9 to 5 forever. And I think that's why I explored real estate as a property manager, my first job here in Australia. I do not have any background in real estate at all, but, I want to thank Mark, who was my boss at that time, for giving me that opportunity. And I think, I owe him a drink. Yeah.
Kudos, Mark. Well done.
Yeah. But I think, that was the reason, I wanted to start something of my own, and being worked as a property manager, and obviously created my own portfolio of properties. I thought this is a good time to start exploring my own business as a buyer's agent. And I think, so, and I've also helped few of my friends, source some properties as well. So in the beginning of 2024, I started I founded this company, which is called Buyers Agent are Us. And, I was still in my 9 to 5, kind of juggling both the worlds, doing my 9 to 5 and doing part-time as well. I was kind of putting like 15, 20, 25 hours every week to my business, setting it up and, helping some of my friends and some clients as well.
Wow, it's a lot of time and dedication. Like I know firsthand when you build any, founding business, and it's that transition of full-time work into, like a corporate role, into full-time your own business. It's a scary, but I'm glad that you did it because, you've obviously helped a lot of people and your friends as well. Like friends is always the starting place, I think, for a lot of buyers advocates. You know, as soon as you become a property advocate, your friends start leaning on you, or family members, and then they talk and they talk. You end up with your business that kind of flourishes.
But I'm a bit selfish on that front. I did not help any of my friends for free, to be honest.
No, good. No, I think that's good because it's a service, right? And then you're also committing yourself though to a level of standards then, because I always say this to everyone. I'm like, look, there's no such thing as a free lunch. If you're not paying for services, but someone else does, my attention immediately has to go over there.
Correct.
Because they've paid me.
Yeah, because I was already part of real estate and I already created my own portfolio. So I know, what I'm going to talk, how I'm going to deliver, those sort of things. I'm not here to learn things, I was already, at a certain level. So I told my friends, I can give you a discount, but I'm not going to do it for free.
No, I admire that. And I was exactly the same at the beginning. You have to. It's just a level of service, and also they get to experience how good you are at full scale.
Correct.
Because the relationship's different.
100%. And obviously, with money, it also brings some seriousness in the business.
That's right.
People sometimes will take you for granted, if you're doing things for free.
Yeah.
That's my perspective.
Yeah, I think everyone listening has been in that position, not just in buying property, but any of their jobs, right?
Correct, yeah.
And look, you've got this great mix of on-the-ground property management, corporate analytics now. You've got your own portfolio. So it's clear that you're not, like another buyer's advocate or a typical buyer's advocate. I want to dig into your philosophy now, because you've said something in our pre-podcast interview that stuck with me. You said property isn't about property. So when you say property isn't about property, it's about finance and leverage. What do you mean by that?
So what I mean by that, Joe, is, property is just an asset class. Let's say if you have got $2 million sitting in your bank, right? And you come to me, hey, Ravi, I want to buy a property and I want to buy a $2 million property because I've got $2 million sitting in my bank. So I think that's not a good approach. Because you should use other people's money, which is called leverage. You should go and borrow money from the bank, and there are many tax benefits of doing it, and that's why property investment is such a wonderful a tool of making money and investing as well. Because again, it's not about property; it's all about finance. How you structure your loan, what finance you can get from the bank. It's all about that. So I would never recommend you to buy a $2 million property because you got $2 million in your bank. That's not the way you should do the investing.
And I think a lot of people, like even for anyone listening, like a lot of these people who probably have a lot of money sitting in their bank accounts, sometimes it comes from an inheritance, right? Like let's say that they've inherited a sum of money. I had this situation happen with a client way back when. They came to me and they said, I got a very big inheritance. I've now got $1 million in my back pocket. I just want to buy a house outright. And I said, why would you do that? There's so many options. Don't do that. And I think the idea of, like, a lot of people say, oh, but it's, the asset grows, you spend the money, and it's like, this is what I want to unpack with you, because you've said it so perfectly, the leverage, right? Use other people's money, the bank's money, to make more, scale your portfolio and have that steadiness, in your income. So, like, I guess, can you give me an example where leverage worked beautifully for an investor, and maybe an example of where it got risky as well?
Yeah, so obviously, when I speak to an investor or a client, I try to understand what are their financial background, what stage of what stage they are in life, right? Whether they are 40 years old, 50 years old, 30 years old, single income, double income, or have kids. So a lot of analysis goes into that. And based on that, I kind of suggest them what to do. So, for example, if you are 60-year-old, you probably would not like to have much debt because you probably would like to retire in 4 or 5 years. So
True.
you probably would like to, have a neutral cash flow property or a slightly positive cash flow property. I would not recommend you at this stage to go negatively geared property because for obvious reasons.
Yeah.
As compared to a 30-year-old, I would suggest them to go very aggressive, have a negatively cash flow properties. Primary aim should be to chase the capital growth instead of cash flow because, you can handle that. You are just 30 years old.
Yeah, you can keep working.
You can high risk. So I think what I'm trying to say here is I'm trying to kind of analyze the risk profile of an individual here. And based on this profile, they should borrow the money. Ultimately, you need to borrow the money. You should not play with your own money. That's the bottom line.
Yeah, and makes sense. And like you said, so your kind of first stepping stone for your investors is one, you understand their goals, right? And
correct.
Like you said, depending on their diversity, or their age group or their background and their goals, you might not recommend someone, like you said, in their 30s to start going for high cash flow. That's
correct.
About capital gains and capital, positively geared. It's interesting because how do you manage someone who does come to you and says, they might be in their 30s and they do say, no, I just want positive cash flow. I want the cash. I want to retire at 40, and they want to be really aggressive with their risk.
Yeah. So obviously, everything comes down to numbers. If you have a plan to retire in, let's say, 10 years, and you are chasing a kind of a passive income. So I need to understand whether it's achievable or not. Not everything is achievable. You can come to me, hey, Ravi, I want $10 million passive income, right? In every year.
That would be nice.
Is it possible? I don't know if it is possible or not, So
yeah.
Let's be realistic, maybe you are on a 100K salary, right? And you want to replace your salary with a passive income in 10 years. Is it possible?
Yeah.
Yes, it is possible, right? So how does the strategy or the plan looks like? What I do, I'll try to reverse engineer from there. You want to have a passive income in 10 years. So in order to achieve that, how many properties you would need to source, right? What are the numbers around those properties look like? When I say numbers, I'm talking about what should be the LVR of those properties, loan to value ratio, right? What are the cash flows? What are the yield of those what are the yield percentage on those properties? So I try to reverse engineer from there. And then I come back to you, hey, Joe, your property number 1 looks like this. Your property number 2 looks like this. Your property number 3 looks like this, right? And obviously we should not park all the eggs in the same basket, right? So we will also have a kind of a diversification plan because we need to understand, property cycles are different in different areas, in different states. So there are, pockets within pockets. So we need to understand those concepts as well.
Yeah, that makes complete sense to me, actually. So it's like that risk assessment and that planning at the start is so important because you're setting them up not just for that one property next purchase.
Correct.
It's how you set up that strategy long term so they can achieve their goals. So it's really a personalized kind of experience, and you end up working with people, I imagine, for years.
100%. And obviously, again, leverage is a big thing here as well. If I'm suggesting you to buy 4 properties in order to achieve passive income in 10 years, we need to structure those 4 properties. I need to know from while buying property number 1, what is my property number 2 looks like. It shouldn't happen like this, that I make a mistake while buying property number 1, and because of that mistake, my property number 2 purchase is at risk, or I cannot buy at all, or I have to wait for 2 years, 3 years, who knows, right? So it's a complete plan from property number 1 to property number 4.
Yeah, and that makes sense because even I've met so many people who they get their principal place of residence incorrect, not necessarily because they're trying to invest, and maybe at that time they're not thinking about investment, right?
Correct.
They're buying their first property to live in. It's a lifestyle choice more than it is a growth tool.
Correct.
And I often talk about the mindset shift, saying, well, that's okay. There are plenty of good suburbs, right? And good performing areas that will do both, suit your lifestyle, suit your budget, but also give you a return so you can turn that into something else in the future, whether that's investing or a bigger next home.
Correct.
So I always talk to like my first time buyer cohorts, like through these channels. This is exactly why we have the podcast. A lot of first time investors are tuning in, first time buyers. And I'm often talking about the power of a buyer's advocate, but also leveraging like that investment strategy from day one, rather than waiting until you've made that first purchase.
Yeah, 100%. And people should understand, mistakes in properties are very expensive.
Yep.
If you want to go back and change few things, can cost you tens of thousands of dollars.
And that's the risk, right? Like, I think we treat property here, in a way that it's the biggest, life goal and achievement that we want, to own our own piece of land and our own property. And it's a great feeling. But what I find scary is we spend more time trying to decide. There was a study done, right? There was a study done about 2023. We spend more time, on average 45 to 55 minutes, trying to choose a Netflix show to watch. And on average, to buy our home where we invest all our savings into, we spend around 20 to 30 minutes tops, and we bet all the life savings. So the contrast of what I always try and get across to people is you're trying to decide on Netflix, but you're spending less time and you're like, here's all my money. Yeah.
And I think I may be wrong, but I think the reason behind that, Joe, is, people may not be enjoying the process that comes around that is around the real estate purchase, right? Or there are some gaps. They do not understand few things. So, they end up investing only 20-25 minutes. But however, on the other side, they're enjoying everything about Netflix or, what plan they want to buy, so that's why they are completely into it, analyzing everything, which should not take that much time as well.
Oh, it's so true. Like, I think you said that perfectly. I mean, I'm actually going to leave it there because it's accurate. It's not an enjoyable process buying property sometimes, because if it's your first time or you don't have a professional, it's overwhelming. It's like, I just want to get into a home and let it be done.
Yeah, and that's why I always say to my clients, as a buyer's agent, I should not say that, but I always say them, it's buying a property is not a rocket science. It's not like working in SpaceX or NASA. We are not innovating anything here, right? But if you do not know the process, if you are scared, or if you do not want to invest your time and energy, then you should speak to experts like me, who have done that in the past and who have helped number of clients in the past as well.
Yeah, I agree wholeheartedly. Like, I think, there's one part like that I want to switch to, and this is a fan favorite. Okay, so we do a segment on this show called Reddit Mythbustings, or Mythbusting Reddit, and it's where our listeners each week, sometimes every day, you guys are savages, you'll send us stories from Reddit of situations, and you'll ask us to unpack them with our guests to get some answers and see if what we would do different, right? So, Ravi, this is what I'll do is I'll read out some of the things that our guests submitted this week. Our scenarios based on Reddit, they're real people, real scenarios that they're going through. They are often asking questions, and then your job is to bust the myths with us and see how you would do this different or how you would help this person. So, are you up to the challenge?
Yeah, sure. I'll try my best, Joe.
You'll be great. So this first one, I'll read it out. This is from the Oz Property Chat. Thank you, Mary, for sending this one in. And this first poster says, is $500,000 for a one-bedroom apartment in Sydney worth it? She continues to say, hi everyone. I'm a new immigrant and married, currently renting in Hurstville, $600 per week with no kids. I have some money saved up, and with my parents' financial support, I would like to buy a small apartment with full payment. That way I don't have to worry about endless rent. I checked on real estate and found a lot of one-bedroom apartments in the $400,000 to $500,000 range near Haymarket and Darlinghurst. I took some inspections and I feel these apartments are okay. I chose this type of apartment based on some of the following reasons. I can buy it with full payment without worrying about not being able to pay the mortgage, which is less risky. That's a key point I'll come back to. The total price is low and centrally located apartment has high liquidity. So if I don't want it anymore, I can sell it quickly. Am I right? My experience with real estate comes from China and I don't really understand if these laws apply to Sydney. Also, do apartments hold their value? I don't expect it to go up a lot, but at least it can't be half the original price when I want to sell it in a few years. I would actually enjoy living in a Hurstville house, but that would cost at least 1.5 million. Maybe I could put that amount down as a down payment and slowly pay off the mortgage. Do you guys have any good suggestions? My household income is around 150,000 after taxes. There's a lot to unpack here. What jumps out immediately?
Yeah, obviously, this gentleman is from China who has migrated in Australia quite recently. And I don't know about the Chinese real estate market, but I've read in newspapers, it's struggling a bit in the last couple of years. They have seen, a really downturn in the market, in the real estate market. Having said that, if you compare the Australian real estate market, it's a very stable market. We have 50, 60, 70 years of data, we can see how stable it is, right? And the latest example is during COVID, all the, analysts sitting in the high rises, they were proven wrong. We have seen that during COVID, the predictions all were wrong. The property still was very stable in those 2-3 years. In fact, the reverse has happened, it has increased like 40, 50, in some areas, 100%.
Yeah.
So that's the first thing. So if you compare with China, right? And the other, if I go back to the question, about, paying everything upfront and, not worrying about mortgage, I think if this gentleman is looking for a PPOR, it's a completely different kind of purchase, Joe. And because I'm mostly an investor's buyer's agent, but I sometimes get inquiries from clients who want to buy the owner of properties as well, and it's a completely different conversation. It's an emotional purchase, right? And it's a convenience-based purchase. If this gentleman wants a convenience in life, maybe he's working in CBD and he doesn't want to, pay on. He doesn't want to travel. He don't care, if the property will double in 5 years. I just don't want to spend 1 hour traveling every day. I want that 1 hour doing swimming, playing basketball, or whatever. It's a completely different conversation.
Yeah, of course.
So that's one thing. In terms of centrally located apartment, I know particularly because I'm from Sydney, so I know the CBD. It's flooded with properties, apartments. So in terms of the capital appreciation, I don't think, and especially with the one bedroom, it's a very low in demand as well. At least this gentleman is, if he's looking to buy something in CBD, at least he should aim for a 2-bedroom apartment if it is possible or if he can afford.
Yeah, that's interesting because what I noticed, right, he wrote here, like, without worrying about not being able to pay the mortgage, right, because he wants to do the full payment. He calls it less risky. What do you kind of say to that, like, in terms of strategy for this person? Because he has long-term goals to invest,
Yeah, see, again, this is not less risky, and if he has goals to invest, I have helped some of my clients doing debt recycling, and I don't know, and many people don't know about debt recycling. They just think debt recycling is, taking out the equity from the house and investing that. That's not debt recycling. Debt recycling means, you are converting your non-deductible debt to a deductible debt. So in this case, buying a PPOR, which is a 1-bedroom apartment, it's a completely non-deductible debt, right? So if this gentleman tweak his strategy a bit, instead of paying everything upfront, he just pay, which is the bare minimum, which is like 20, and 80% he can borrow. Then he has an opportunity to convert that debt into a tax deductible debt in future. if he plans to buy investment property.
That's a good point. So it's kind of like, your kind of, I guess, tip to this person would be, before you spend all your money on it, you need to look at that, exactly what you kind of take your buyers through. It's that,
Correct.
What's the goal?
Correct. If I just remove the appreciation part, or whether it's a good purchase or not, let's forget about it. If he wants to buy this one bedroom apartment for whatever reason, because of the convenience or whatever, maybe the apartment block is excellent. Who knows? They have the world class gym or a swimming pool. Some people like that. Right? So let's assume he is going to buy that. He loves that apartment. He loves that property. So my recommendation would be just to pay bare minimum and have the remaining amount left in the offset. So you are only paying principal. You are not paying the interest part, right? So in this case, $500,000 is the price of the property, and he got $500,000 sitting in the bank. So just pay, which is 20%, and have $400,000 in the offset account, right? So let's say in 1 or 2 years, if he wants to buy something as an investment, right, he has an opportunity to convert that non-deductible debt to a deductible debt.
So, okay, that was really smartly put. I think that everyone, you put that very simply, that's what I like. I'm like, so for everyone tuning in, thank you so much, Mary, for submitting that story, because that was a good one to unpack with Ravi. I have one more for this segment that I want to go through with you, not as long.
Sure.
So this next one is interesting. So it says, this Redditor says, are any of you not investing in property? She goes on to say, just curious to hear opinions. I've never been a fan of the property market. I've been investing mostly in stocks for the last decade. I own the apartment in which I currently live, but I don't have any plans to purchase investment properties, just my principal place of residence, which I will buy once I'm looking to settle down and have kids, etc. This one's interesting because in the comments, people are debating if property is even worth it. And some say the only reason it works is because of leverage. So do you ever run into the scenario where sometimes property is not the right strategy for someone?
100%. It's a coincidence. I just had a discovery call with one of the prospect yesterday. And, this gentleman said he wanted to buy a property. And his plan is to sell off, let's say, in 1 to 2 years' time. And he have no experience of property in Australia, right? Wow. So, and I told him, why are you considering property then? Why do you want property as an investment class? Because if you just want to hold for 1 or 2 years, you need to consider the holding costs. You need to consider the costs which are involved when you buy the property. You need to understand there are costs when you exit, when you offload the property, and let's not forget and let capital gains. Right? Property is a good investment, but it's not going to make you rich overnight. It should be a long-term strategy, right? So
100%.
So I told this gentleman, why don't you buy, shares or Bitcoin, whatever it is. Why do you want to invest in property? I think for you, in investing in property is not a good plan. It is good. It is good when you have some experience, right? You hold a couple of investment properties. Let's say you hold your own PPOR as well. You have some experience in real estate in Australia, and you want to do flipping, right? You want to buy an asset which is below average market value for whatever reasons. You want to spend 150K for renovations, new bathroom, new kitchen, new flooring, whatever, and you want to flip in 1 year or 1.5 years. You can make money in that strategy, but it's not for a beginner. I think that's for the pro investors, right?
So it's just different strategy at different stages, really.
Correct. And obviously, and I agree with this question. It's so this is one of the examples where property cannot be the right asset class for you to invest, right? But what makes property unique, I think, if I compare with shares, right? The first one is obviously leverage, which we have discussed already. For property investment, you can borrow up to 90-95%, and in some cases 100%. I have my own in one of uh, in my own portfolio, I have one property and I paid $0 out of my own pocket. Even the stamp duty was
Wow.
even the stamp duty was covered. So
Jesus.
yeah, I bought this property in Townsville, and the property value was around 470K, right?
Nice.
And I took the equity out from my own PPOR, and I got the loan of $500,000. So even my stamp duty was covered. So
That's amazing.
I did not pay a single dollar out of my own pocket. Can you do it in shares? No.
Yep, that's true.
Right. Again,
That's
the
so true.
the other unique and powerful way of playing around property is, as I said, you can do renovation. You can do flipping.
Yep.
you can spend some money. Maybe every dollar you spend, you get $3 back. That's a thumb rule. That's a thumb rule in property. I have a client who I helped last year buy a property in Mackay up in Queensland.
Oh, yeah.
The property was in an excellent area, good suburb, massive block of land around, I think, more than 650 square. And now
Wow.
my client is putting granny flat. So
Oh my gosh.
he's making that property a cash cow. And
Yeah,
I think
he's turning it into something.
I think he's planning to spend around 250 or 300K, and which will uplift his cash flow to around $1,100 a week.
Wow.
So can you do it in shares? No.
No, it makes it hard, makes it different, right?
Correct.
And that's that play that you're talking about. I love the way you've answered that. Thank you for participating in Reddit Red Flags and How to Myth Bust. I think you actually did a really good job with those two. Because they were unique cases, right?
Correct.
And I want to switch gears into, your case studies, which we've started talking about. But on the flip side, like you said, you kind of gave us an example of what looked good on paper. But if we look at the other side, what's a deal that you've been most proud of helping a client secure? Like, is there a particular customer or client that you think of and you go, I'm so glad I worked with that person. What a good win.
Yeah, I think I would go with the same example which I was giving here. This client I helped secure a property in Mackay last year. So that was an off-market deal. So I had a good relationship with the real estate agent, and she presented me the property. She said, Ravi, hey, this is a really good property. It's I've just listed this property. I've got the Form 6 signed, and you are the first one I'm telling, because obviously
Yeah, the relationship.
because of the relationship. And I said, okay, let me speak to my client if he's interested. The numbers were really strong. I think the property value, the asking price was 570, because Mackay was really growing last year. It is still growing, but I think it has peaked up now. But it was really in a good point at its cycle last year. And I did some numbers, and I think the yield was more than 6.5. So I think we were aiming off the rent we were aiming was around 700. So imagine 570 was the price of the property, and we were expecting a rental of 700 per week. So it was a 4-bed, 2-bath, double garage property, and the land size was more than 650.
Wow.
So I rang my client and I said, here is the deal. It's a really fantastic property. What do you think? It was slightly above his budget. His budget was in the low fives. But again, he spoke to his mortgage broker, and his mortgage broker was convinced because the numbers looks fantastic on paper. So we made an offer, and it was accepted.
That's amazing. I love that example, right? Because it's that trust factor that he had in you as well, to say,
Correct.
I think sometimes what I've always tried to say to buyers is keep an open mind. Like, if you are dealing with a buyer's advocate, oftentimes they're not going to suggest something that's not going to work for you.
Correct.
They've done
Yeah.
all the number crunching. So if you've given yourself this limit,
Yeah.
if your finances support it and it's going
Yeah.
to get you that return, like
Yeah.
this gentleman
Yeah.
that you worked with,
Yeah.
it's a
Yeah.
no-brainer.
Yeah, and my client knows me, Joe, very well. I'm a bit hard person. I'm a very straightforward person. I sometimes go hard with them. Sometimes I don't listen to them, because investing is not emotional game. It's all about numbers. Many clients I've seen during the process, they get emotional. Hey, Ravi, this property is not very old. It looks newish, new paint, new carpet, blah, blah, blah. And I was like, the numbers doesn't look good on Excel or on paper. I
Yeah.
would not recommend buy. If you want to buy, go buy yourself. I'm not helping you.
And spot on. And then how do they snap out of it? Like when you say something like that, where you go, yep, you can buy it. I'm not going to help you. It doesn't look good. I'm
Yeah,
sure you
no,
don't have a lot of people that run and go buy the property.
no, it has not happened yet. Obviously, they. I back up. I back my whatever I'm saying with some data as well. I'm not making false promises here. I tell them, if you buy this property for whatever reasons which you like, right, how it is not going to fit into your strategy. Because again, as I said, I need to buy property number 2 and 3 for them as well in the next 6 or 1 year or 2 years, right? So if you buy it now, you're not going to buy your property number 2. Your property number 3 will be impacted. So you are playing with
Yeah.
your strategy.
Yeah, it's so true. And I think you've put that perfectly. I guess, those that you've put it into a reality, I think, for a lot of people that, don't know what to expect with working with a buyer's advocate. And it's like, this is the power of having the right people in your corner that can actually help you come back from the emotion when it gets too emotional, or do the data and the research and the number crunching to make sure it makes sense. So
Yeah.
it's so powerful. I guess I want to switch gears a little bit before we wrap up, because I really wanted to get to, your key principles and guidance for the listeners, right? Because are there any, I guess, non-negotiables that you have before you ever recommend, someone buying property?
Yeah, I always look into the building and pest reports,
That's
so
so
which is
important.
it's very important. But having said that, it doesn't mean it's a deal breaker. But based on that report, you kind of unpack many things about the property. i have
Yeah.
i have my own renovation background, Joe. I have renovated my own PPOR, through my own hands, because I developed this hobby during COVID days. And the moment I enter into a property, my eyes are like x-rays. I can scan the walls, what's
Yeah,
in
of
there,
course.
So because I know many times the real estate photography is not true. They
Oh,
they publish some photos on realestate.domain.com, which is not actually the property how it looks like. I scan it, and I know there are some issues in the property. Maybe the agent is trying to hide few things, or maybe there is a new coat of paint the owner or the investor has done, and it's all about hiding few things. So I know how important is building and pest in that case. So
yeah.
if I found anything, if I think there are few minor things, but I still negotiate very hard on those things. But if there are
Yeah.
some structural issues, I alert my client, are you happy to buy? There are some structural issues. Again, if there are some structural issue, doesn't mean we should not buy that property, but we should analyze the cost around it, right?
Yeah,
and
of course.
and based on my client's risk profile, I tell them, if you are happy, because many of my clients, they are buying their property number 2 or 3, right? They are very
Mm,
comfortable in property investment now. So maybe they are on a next level where they want to buy undervalued properties, happy to spend 20, 30, 40 grand or 50 grand to just uh, make a
fix
face
it up.
excel it up, and and they want to make profit. So those kind of clients, they are happy to buy those properties. They know that even if there is structural issue, let's say there is a structural issue in the roof, it will cost them 10,000. That's fine.
Yeah, it's because they're aware of it and they've got a bigger plan
Yeah,
behind it
yeah,
and a bigger
yeah,
strategy.
yeah. But again, coming back to your question, this is a non-negotiable thing. Building and pest, I just cannot bypass it.
Yeah, I agree with you wholeheartedly. Building
Yeah,
and pest is number one for because
yeah,
you can't see, right? You can look and you can see
correct.
signs, of course, but when you're
Yeah,
not the expert and you don't do this
100%.
every
Yeah,
day,
yeah. No, I'm
how
not
are
an
you going to
expert.
know?
Yeah, no, I'm not an expert. I have done renovations. I know a lot of about renovations, but there is only few things I can see and I can do, right?
Yeah, 100%. And
Yeah.
I guess, how do you kind of tackle that, when you get clients that really focus, like, I guess, how do you get your clients to focus on finance first when all they want to talk about is suburbs and location and where to buy or what to buy?
Yeah, no, I have these discussions day in, day out, Joe. Even if I'm having a barbecue at a friend's place, obviously they know
Yeah.
me, what I do, the first question they ask me, hey Ravi, what is the best place to buy? Which suburbs you are buying? And my answer is always like, mate, I don't know for you what suburb I should propose, right? Again, I'll quote the same example. A 30-year-old will have its own strategy, right? And a 60-year-old will have his own strategy. So, for a 60-year-old, I probably would be buying in a very high cash flow suburbs, right? Where, he can enjoy those
His retirement.
his
Yeah.
retirement, days. For a 30-year-old, he can handle the negatively gated property. He can sit on that negatively gated property for like 4 or 5 years and then enjoy the capital growth. And then, he can see that compounding magic for next 15, 20 years, right?
Yeah.
So again, what is the best suburb to buy? I don't know. That is the simple answer.
Yeah, and I don't think any of us know because even like I have another question here that says, someone's got 100K of equity to work with. How do you deploy that? But it comes back to the same question, right? It's the same strategy. It's the
Yeah,
person, their risk appetite, and
yeah,
then what they can and can't do with that equity will change dramatically from person to person by the sounds
correct.
of it.
Yeah, correct. If you got money, you exactly have same financial background uh, as compared to other client. But again, your strategy will be completely different based on
Yeah.
what you want to achieve. Even if you are 30 and you say, Ravi, I want to retire by 40, right?
Mm.
Again, the conversation completely different.
Yeah, because there might be another 30-year-old that says, I want
Correct.
to own $1 million property with my
Correct.
family in this
Yeah.
particular suburb in 10
Correct.
years.
Yes. Correct. So it's a completely different. So it's not a one strategy fit all. So that's why it's not a one suburb that can handle all the requirements.
Yeah.
Yeah, I might be buying for a client in Melbourne, but I may not suggest the other client to buy in the same city or the same suburb.
Yeah, correct, because it's just not gonna suit. So and that's
Correct.
what I love about, working with a buyer's advocate like yourself. You get a personalized strategy, which is
Yeah.
missing from the traditional kind of,
Yeah.
approach. Like if you're going by yourself, you're talking to the real estate agent, you'll be told the same things, you'll go
Correct.
through the
Correct.
motions, you'll buy the property, and it seems very impersonal. But a
Yeah.
buyer's advocate is just looking at everything
Yeah.
and you've got a
Yeah.
team of people around you.
Correct. Yeah. And having said that, Joe, I mean, I see a lot of people talking about suburbs on YouTube and whatnot. I mean,
Mm.
a client can also do a quick search on ChatGPT. They can they can do hey, I've got 600K uh, as a borrowing. I want to spend this money buying a property. Suggest me some good suburbs. ChatGPT can do it, but ChatGPT doesn't know about your background, right? ChatGPT
That's
doesn't
right.
know where do you want to go. After 10 years. So what's your motivation?
Yeah, exactly. And this is kind of what I've done with a Bodhi, right? It's like, no, you put these into an intelligent system and then we can map that for you if
Correct.
you're really looking at properties and suburbs and growth. But again, it's a very fine art of orchestrating all those data
Yeah.
points. My final question to you is if you want our listeners to take one thing away from today's episode, what would it be or what should it be?
I think the one advice that I would tell all your audience is, uh, real estate investing or property investing, it's not very hard. Do not get carried away, with people who say, they have got 20, 30 or 40, properties in their portfolio.
Yeah.
I mean, you need to understand with 20 properties comes, 80 bedrooms, 20,
Yeah, true.
isn't it? Maybe 40 bathrooms, 20 kitchens, 20 hot water systems. So all you need is, I think for me, my strategy normally is, you need to have three to four good investment properties. Good properties. When I say good properties, they are located in, good suburbs, growing suburbs. The bones of the property should be good. Those sort of things. You don't need 20, 30, 40 properties on an average.
Yeah, no, like you said, that's a lot more bathrooms,
Yeah. and, and
a
and
lot
and
more
and the
maintenance.
good thing about that, Joe, is this 3-4 property goal is pretty much achievable on an average Australian salary of 80, 90, 95K per a year.
That's
It's
amazing.
it's really achievable, and you don't have to compromise on your avocado toast as well. You can still enjoy your lifestyle and keep doing this investment to achieve these 3 4 properties in your portfolio.
I love that. That's a great way to wrap it up because you said it's achievable on the average Australian salary. So, like to all our listeners today, a lot of you guys don't feel like you have to already be a millionaire to invest in property. It doesn't start there, and a lot of these millionaires don't start with $1 million in their pockets. Some maybe, but not all. So, I hope this inspires you to get in touch with Ravi and have that open discussion. Like I always say, it costs $0 to have a coffee and a conversation with someone like Ravi to understand how you can start investing, or if you're not starting, but how you can manage a portfolio and make it work for you. So, Ravi, thank you so much for coming on the show today and sharing all your wisdom. It was really inspiring.
Thanks, Joe. Thanks for having me.
Of course. Now, if you want to connect with Ravi, his details will be in the show notes below. And like I said, it costs nothing to have a chat. So call Ravi, book a time, and see what your options are. Thank you for tuning into the No BS Real Estate podcast on Spotify. If you've enjoyed this episode, please like, subscribe, and share it with a mate who's looking into property. We'll catch you next time. That's a wrap for this episode of the No BS Real Estate podcast, powered by Abodi AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodi.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodi AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodi.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.